What if the biggest financial disasters in history weren't accidents at all? What if crashes weren't just the unpredictable result of human panic? Every time the global economy melts down, the same story is told. It was a rare shock. It was a once-in-a-century event. Markets rise in perfect euphoria and collapse with mathematical precision. Debt explodes. Power centralizes. Tonight's question isn't whether crashes are inevitable. It's whether they're scheduled by design. To understand modern crashes, you have to understand the machine behind them. In 1913, a private banking consortium was granted control over the money supply of the world's most powerful nation through the creation of the Federal Reserve. This single institution gained the power to create money as debt, set interest rates, and expand or contract liquidity across the entire economy. Almost immediately, the economy became something entirely new, a credit-driven system, where growth depended not on real production, but on expanding debt. 16 years later, the world faced the Great Depression, a catastrophic implosion that erased fortunes, destroyed employment, and terrified governments into rewriting the rules of finance. But instead of dismantling the debt machine, global leaders doubled down. After World War II, the world rebuilt its financial system at Bretton Woods system. Currencies became fixed to the US dollar. The dollar became fixed to gold. Then in 1971, a single televised announcement changed everything. President Richard Nixon severed the dollar's tie to gold in what became known as the Nixon shock. From that point on, money was no longer backed by anything scarce. It became pure confidence, backed by debt. And that's when crashes stopped being anomalies. They became features. Here's the mechanism that silently schedules collapses. Easy money floods the system through low interest rates. Asset prices inflate, stocks, homes, bonds, everything. Eventually rates rise, liquidity tightens, or confidence cracks. This isn't a flaw. It's how credit-based expansion must behave. In the early 2000s, after the dot-com collapse, interest rates were slashed to historic lows. Cheap money poured into housing. Banks created millions of subprime loans. Everyone made money on the way up. Then in 2008, the illusion broke. Mortgage debt grew faster than wages. Financial institutions were leveraged 30-1. Inside the system, risk models flashed red. But profits were too intoxicating to stop. The derivatives market exploded into the hundreds of trillions, and nearly every major bank was interconnected in one giant web of counterparty exposure. At the center of this expansion stood institutions like Lehman Brothers and policymakers, influenced by figures such as Alan Greenspan, who openly believed markets could self-regulate. In September 2008, liquidity disappeared overnight. When Lehman fell, the world discovered the terrifying truth. Trillions evaporated in days. Retirement accounts vanished. Instead of allowing the system to purge its excess debt, central banks printed unprecedented amounts of money to save it. Banks were rescued. Markets recovered faster than ever. Asset inflation that priced them out of ownership. Meanwhile, global institutions like the International Monetary Fund expanded their influence, offering debt-based bailouts to struggling nations, with conditions that often locked countries into decades of austerity. Once again, the crash didn't destroy the system. New regulations are passed, then slowly, quietly, those rules are weakened. Stable systems don't generate infinite profits. By 2019, global debt exceeded $250 trillion, more than 3 times global GDP. Markets reached record valuations, then 2020 arrived. Once again, the crash didn't cleanse the system. Sovereign debt at historic highs, equity markets disconnected from productivity, central banks trapped between inflation and collapse. Financial crises are now occurring faster. Wealth becomes more concentrated. The system requires collapse to restructure power without ever calling it that. Crashes aren't triggered by one bad decision. When debt grows faster than income, when leverage grows faster than productivity, when asset prices outpace purchasing power, collapse becomes not just likely. Not because the system failed, because the system completed its programmed cycle. 1. Crashes redistribute wealth, not eliminate it. 2. Stability is temporarily manufactured through expansion, not reform. 3. Timing is hidden, but the sequence never changes. Different actors, The danger isn't that the next crash might come, and when it breaks, the headlines will again say, "Nobody could have known." Subscribe for deeper breakdowns into the hidden mechanics of the financial system. It will be marketed as inevitable. And inevitability is the most powerful disguise of all.